My name is Quinn Cowan. I'm the CFO and a director of the Investors Central Group. And this is our first public presentation since October 2019. That being said, it is a great pleasure to see so many familiar faces here today. We'd like to thank you all for taking the time to come to our presentation. We'd also like to thank all our current investors for their continued support through these challenging times. Last financial year, that was the most challenging year we have had in our 10-year history. We have had some great highs and we have had some very low lows through that. For instance, August 2019, we settled $13.7 million in loans. That was the company's record to date. We were averaging over $10 million a month prior to the COVID-19 pandemic. Then come March, April, we ceased lending for 6 weeks. We had to stand down the majority of our originations team and moved as many staff as we could into our collections department to help service our customer base. That being said, our cash flow through this period has exceeded our expectations. We actually averaged 116% of our forecast projections of cash flow, which is a great result. We believe this shows the strength and diversity of our loan book. This coupled with the hard work and dedication of our team, plus obviously the various government stimulation into the economy really had a positive impact on our market sector. Moving forward, we're currently sitting on just over $42 million in cash in the bank. It's the most cash we've ever had. It's up 49% from pre-COVID-19 levels. This provides us with the funding for future growth over the next 6 to 12 months. I'll just leave it there because Jamie will talk a lot more in depth when he does his presentation. Now I'd like to welcome Darren Tham, the head auditor at Jessops, to come up and do a quick brief summary of the audit process for the year. Please welcome Darren Tham.
Thank you all. Thanks again, Jamie, for inviting me along for the free lunch. It's always, as an accountant, something that we really appreciate. For those that don't know who I am, my name's Darren Tham. I'm the auditor and a partner in an audit firm called Jessops, which is based here in North Queensland. Proudly North Queensland. We've got offices in Townsville and Cairns. Our office has been running in various forms since 1997, and I think I saw the founding father is here somewhere as an investor of Investors Central. So there's actually the owner of the firm that I bought out. He took my money and brought it down here and gave it to Jamie. So I've been involved with Jamie since 2016, I think it was, when we first started doing the audits with Jamie. The firm itself has been involved with Jamie since 2013. So we've been through some ups, some downs, and just seen significant change over that time. I guess I'll just quickly, for those in the room that don't understand what an audit is, I'm just going to quickly explain the audit process. A lot of people don't understand the terms. The only time they've ever heard of an auditor is when the tax office bangs on their door and wants to know about their tax deductions from last year. I am not a tax auditor. I am easiest way to explain this to the less financially literate, I provide comfort or assurance to the general public as an independent person that the financial reports that you've got sitting on the table that have the numbers of the performance that Jamie and Quinn are going to talk about for the last financial year, I'm giving you comfort, reasonable assurance that you can rely on those numbers, that they're free from material misstatement. I'm not giving you any guarantees. I'm not giving you anything. I'm not giving you certification that the company is perfect. I'm giving you reasonable assurance that the financial report is free from material misstatement. That means that you can trust the numbers, that they're pretty right. The way we go about doing that is we look at the companies and we analyse risk. The risk of the numbers being wrong. the risk that there is a material misstatement that appears in those numbers. So we look at key risks, and then we understand the processes around those key risks that the organisation's put in place, and then we check to make sure that those processes are diligent enough to make sure those numbers are right. Part of the risk analysis that we do is getting to understand the company and the culture within the company. There is a way of looking at an organisation. I was explaining to Tim at my table. The numbers themselves are a picture, a snapshot in time of what has happened over the last 12 months. Quinn, you explained we've had some ups, we've had some downs. All of those numbers are telling a story. There is humans involved in that story. They create the numbers. The customer care team looks after collecting the money that is lent out through Finance One. The credit team are responsible for lending that money in a responsible manner to people that require those funds. Those humans create the numbers through what they do on a day-to-day basis. When we look at an organisation, we look at the culture, how a business operates. And I've said this, I think, every year. Jamie has a very strong culture with Invest Central and Finance One. You talk to any of the staff, and there are a fair few scattered around here today, see if you can find me one that says something bad about Jamie. You won't. What that means is everyone does their job properly. Everyone does their job well. And that, as an auditor, means I can lower my risk of the numbers being wrong because people are taking pride in what they do. Does that make sense? Yeah, good. So what we did pull out as what important things we wanted to look at within the numbers. We looked at several things. We looked at the impairment of the receivables, the loan book. How recoverable is that loan book? It's a big number. That's where all of the investors that have put their money into Investor Central, that's where it's all gone. And that's, I guess, what everyone in this room really wants to know about. If you have a look at the bad debt provisions, and I'm sure Jamie will talk about these shortly, you'll see that the company has a very strong record of collecting cash. And that goes back to the human story again. You've got a strong customer care team that establishes good relationships with the clients. That, as an auditor, I can see on the files. Does that make sense? We actually went in and we looked through line books, I looked through the application process, I looked through all of those controls, I guess looking for the ones that are wrong, that are not meant to be there. We couldn't find any significant problems with what was there. So we were satisfied with the controls that the organisation has in place over its loans receivable book. We also had a look at the revenue recognition. How do we pick up revenue within the company? Because that's the other thing that's very important for investors. How do we show that big top line item in the books? We went through the contracts, we looked through the interest rate calculations, and we did that in detail to make sure that those calculations were properly done. There was a couple of other interesting accounting standards that came across. For those of you that would like me to, I can sit and explain them to you for half an hour at the end of this presentation. For most other people, accounting standards mean the way that we record and measure assets and liabilities. There were two changes this year. There was a new standard for revenue, which came up with new criteria on how revenue is recorded. And there was a new standard for leases that came about of how you need to record leases. The revenue standard didn't have any major impact on Investors Central and Finance One. The leases standard, however, did. What it meant is now we are recognising a right of use asset and a right of use lease liability in the books. So you will have seen a magic number appear for those investors that have been with the companies for a while, and you would have gone, hang on a minute, what's that? We're now recognising when a company has the right to use an asset as an asset for the organisation, which means rental expense is no longer just rent, now it's an asset and a liability. But you'll see that in the financial report, and I'm happy to talk to anyone who wants further explanation of that after this, rather than boring everyone else in the room. Quinn mentioned COVID-19. As auditors, we were concerned. when COVID-19 rolled out across all of our client base, as I'm sure everyone in the room was, because when we wind back to February, March, it was quite scary times. It was something that we needed to consider during our audit planning, because it was a key risk that we needed to make sure was addressed, particularly as it related to those numbers that would be significantly impacted. Impairment of the loan receivables, going concern potentially. We didn't know what the results were going to be. We came out in July to do our audit testing, and we're pleased to note, as Jamie and Quinn will mention, that there wasn't as significant an impact on the financial reports as we expected from COVID-19. The company has sailed through with minimal impacts on the organisation's financial results. Interestingly, the cash collections went up, not down, which sounds completely contrary to logic, but having looked at it, it appears that the stimulus money, the ability to access super, those types of events that were external to Investor Central and Finance One actually resulted in people paying off loans more rather than the other way around, which is good for those people that, as the investors in the room, that is a good thing. So that's kind of all I had to say about the audit. It went well. It was an unqualified audit opinion. An unqualified audit opinion is good. It means that I was unable to find anything that would mean that I needed to qualify my opinion in any way. The financial statements present true, fair view in accordance with the accounting standards. So I'm going to be around, so if anyone wants to actually come up and ask questions face to face, it'd be easier that way. Thank you.
Thank you, Darren. It's always a pleasure to hear your view on our company. Just before Jamie comes up for his presentation, we'd just like to play a short film that the management team at Investor Central and Finmana put together, just talking about the COVID event that we went through at Finance One.
Mid-March, Friday came, and that week leading up to mid-March, we'd had a business plan that every day had changed. We thought we had it solved, and then come the weekend, there was chatter about whole industries stopping and changing, and people being letting go. That weekend, all our leadership team worked the entire weekend. Previously that, we'd been working 100 hours every week.
The new reality set in pretty quickly for me that COVID-19 was an event that was going to have an impact on us all, both for me in respect to my work and personally.
As a CFO, it was pretty stressful. The uncertainty of everything was added to that. So not knowing how the economy was going to go, the greater economy, for us it was really important to make sure that we could survive this.
We had 500 or 600 investors that had put a significant amount of money in the company, and that was probably my primary concern. I mean, staff were a concern, but I felt the investors were my primary concern as a director. And we had to ensure that the business was safe and that we took all necessary precautions to be able to meet our commitments to everybody.
I phoned our accountants. I phoned our auditors. I also called federal ministers to get an idea of what was going to be happening to the economy moving forward. And everybody that I spoke to was quite worried. This is pre-Job Seeker and Job Keeper or any stimulus package has been released. And that worry was, and the feedback was, that we were going to be shut down for 6 months, a minimum of 6 months, and this was going to be huge. Some of the federal ministers that we spoke to, there was, in their modelling, it was going to be 100,000 deaths through this, and they were taking a very cautious approach. So over that weekend, which transpired through to Monday, which is when we came in and we stood down 45 of our team members, we pulled all settlements, we took a very cautious approach to moving forward, that we wanted to be in a defensible position right through to December of 2021 is how we modelled that business from that day.
We made the decision on the 23rd of March to cease lending in the short term. We had no idea what was coming with the shutdown orchestrated by the Australian government.
And so doing that, the first thing I did was to figure out our cash flow position and to make sure that we had the money to be able to survive it. Being able to pay back investors as their redemptions came due, keeping as much staff and keeping the business going was our priority. We took a worst case scenario of if we have 100% of people want their redemptions and we have maybe possibly only receiving 20 or 30% of our funds back from our book, then we were going to be in a cash flow shortage, which was not going to be a good position. So that's why we took those drastic steps in March to basically stop our lending and maintain as much cash as possible on hand until we knew what was happening. So through March, and we stopped in April, and then we realised, with the JobKeeper and all those sorts of things, things weren't as bad as what we originally thought. And if anything, the cash flow has been the strongest it's probably ever been due to all the government support and just people paying back their loans through that period, which has really surprised us.
It was important that with the increased amount of accounts being closed due to payouts, that we were cautious in our approach to our return to lending in May, while also ensuring we continued to comply with responsible lending obligations during these times. The restructuring of the lending department through technology allowed for processes to be streamlined, which brought confidence when re-entering the market.
During the COVID-19 event, I mentioned before, we stood down 45 of our team members. That was a brutal day, making that decision, because we took a very cautious approach. And what we wanted to do, we stopped our lending. We even pulled settlements that were due to settle in March, because we didn't know where the economy was moving forward, what industry sectors that we should be lending to. So we let down some brokers and we let down some of our team members by standing them down and stopping lending. But our priority was to our investors' principal. How was I to settle one of those loans where that's another $20,000 that we could be returning to our investors? It was tough. It was very tough. And still to this day, I think about it regularly. However, we made the right decisions.
45 people being stood down was one of the biggest days of my history and my career.
Yeah, it was a tough decision we had to make. I'd been through something similar in a previous life with retrenchment, so I'd experienced it firsthand in a very close basis, I suppose. And it was very difficult and that everyone in a particular department was affected. But it had to be done. We had no options, I don't think.
One of our investors' words of wisdom was that in any crisis, 4 weeks, remain calm, Jamie. And we did. And our leadership team did remain calm through that event. And I think during a crisis, it's really important that you make good, sound decisions and you don't panic, which we didn't. We met every day and we deconstructed the events that were transpiring. And we made good, sound decisions to protect our investors first and foremost, which in turn looked after the business.
I think it was a time where our leadership team had to step up because we had 100 staff relying on us to be able to communicate to them what was going on as we found out information. It was unbelievable the amount of time we had to spend looking at government pages, checking news reports, going through all these different things with emails and things like that to try and get information that we could then relay to the team that was stood down.
We were meeting daily and we'd talk about the changing conditions, and then we'd make sure that we're all focused on achieving our goals and making our company secure.
And it really did test whether people were able to be flexible and adaptable, and I did see that happen, and it was actually very exciting to see not only managers but other staff learn other areas of the business and cross-train and upskill and really unify as a team, and that was really what got us through the past 5 months.
You could not ask for a better team to work with. Everyone rallied around, everyone was here working extraordinary hours, supporting each other, because it was a very emotional time when it was going through, but just due to the camaraderie and the friendship, it's like one big family here.
From both a personal and professional point of view, I have been able to see the impact of that COVID-19 has had on the business and what the organisation has done to navigate through these uncertain times. I work for the company and started in the direct business department, and after the disruption of COVID-19, I transitioned into the customer care team to help collect money. Our desire to excel in customer service and have true connections with our customers has helped us through this period.
They rolled their sleeves up and they worked harder than they've ever worked before. Our entire leadership team was staunch in their resolve that Finance One would succeed. That was inspiring to me, and I am so grateful for the efforts that they showed through this event. I am so lucky to have a dynamic leadership team around me during times like now.
We're in a stronger position probably before we went into COVID. COVID has given us time to sit back and look at the business as a whole, the way we run the business, what we do inside the business. So it's really probably been, not to say a good thing, but it's been a thing that's helped us refocus on our original goals that we started at. We know we were hitting our goals and going that way, but it's been a really good time for us here as a team to see what we've done and how we've achieved that, and we can only see the future brighter for people that are a part of Investor Central.
What's been great through this event is we have over 500 investors that help support this business, and the overwhelming support from them through this has been really appreciated. It's really taken the pressure off us, and it's also shown that they have faith in our abilities to do what we need to do our job, to get the job done, and that has been at the forefront of all of our decisions is to look after the capital and our investor base, the directors included as well in that, because we're all preference shareholders just like you are, so all our interests are aligned on that front, and it's about surviving this event, coming out the other end, and then being able to be able to grow even stronger after this.
We've taken all necessary steps to protect our business, and into the longer term protect the interest of our investors, and we'll continue to do so into the long term.
I look forward to helping more Australians find financial freedom through the opportunity of owning a motor vehicle, providing them freedom through transport. That's what we do, and we treat our clients with respect and dignity, and we build rapport with all of them. And I look forward to helping more of those customers into the future.
Good afternoon, ladies and gentlemen. It's a great pleasure to see you all and be here this afternoon for the presentation of our annual report, along with an in-depth update of how we went through the COVID-19 event. So wonderful to see all the faces out there. I still remember catching up with a couple of investors at 53 Thuringowa Drive. That was our original office space, and we were having a cup of coffee. And it was important for them to relay what it was to have an investment in our company. The monthly interest that they were receiving gave them an opportunity to go out for an extra meal. This is how they described it, from time to time, and also buy something for the grandchildren. It was a powerful meeting, and I still remember that with fond memories. The obligation that I have to all of you is paramount. And I wear that with a heavy heart, and I will do everything in my power to look after all of you. Excuse me. The messages of support that we received during the COVID event were incredible. We received phone calls and emails offering from investors whether that was, is there anything that they can do to help us during our time of need if that occasion arose. Whether that was holding off interest or whether that was pausing interest for a moment in time. I'm very grateful for all of those messages of support. They meant the world to me, and I'm very pleased that we're in the financial position that we are today. We made significant changes. We paused our lending and we came back to the credit market with a reduced suite of products, identifying which industry sectors that we wanted to lend to, but also profiling and targeting our best performing loan products. We had an assistance to borrowers campaign that we've never had before. We wanted to be there for our customers in their time of need. If they needed a payment arrangement, we were going to be there for them. We developed new software through our IT team to be able to deal with the higher level of calls that we were receiving on a daily basis. Our IT team knocked out a new platform so that we could have the absolute highest level of service that we could do for our customer base. Our cash holdings, they grew to over $45 million at one stage there because we paused our lending, and as Quinn alluded to before, they were very, very strong. We also increased our provisioning for doubtful debts to make sure that we included all of those COVID-19 accounts. We looked at every cost within the business and looked for initiatives to be able to reduce those costs so that we could be more competitive than ever before. And we communicated to our investors on a regular basis, providing them updates on how we were performing. If we deconstructed the COVID-19 event and what it means for Finance One, we had 1,546 clients enter into a COVID-19 payment arrangement. Out of those 1,546 customers, 1,514 continued to make payments. And that's an amazing result. There's only 32 accounts that have been unable to make a payment since COVID-19 started. Over 97% of those clients continued to make a payment, albeit some of them in a reduced form. Finance One has specialised in managing people throughout the life of their loan. Up to 30% of our customers will miss a payment during the life of their loan, but it's how we engage with them and work with them over that period of time. If we looked in detail between the two loan books of commercial loans and consumer loans, our commercial loans during COVID, 16% of them entered into a COVID-19 payment arrangement at that time. And if we looked and compared how we sit in the industry sector, other companies like Prosper were at 31%, CBA 15%, ANZ at 18%. That's reduced down now. You can already see it's starting to reduce down to 15%. And when you compare it to the overall pool of loans, it's a great result for Finance One. Our consumer loans were even better performers. Consumer loans was 8.52 when you compare that to CBA at 8.3 or ANZ at 14%. We've seen an even more dramatic reduction since March in those accounts. They are down to 5.45% of the entire loan book. Commercial accounts only make up 22% of our entire loan book value. If we looked at our arrears, overall arrears of the loan book and where we sit compared to the two, our consumer loan book from 0 to 90 days in arrears is at 85%. If we looked at the commercial loan book, it's still a better performer at 88%. Commercial loans are still performing better than consumer loans. Commercial loans have been more affected during COVID. We welcome Victoria opening up and letting some businesses start to operate and thrive again. We're looking forward to that. A recent survey by Ilion, which is a credit reporting agency, looked at the payment priorities for consumers of which bills that they wanted to prioritise to pay compared to 2010. Now this was done in March, so it looked at your gas, your mortgages, your car insurance, even Afterpay. The number one payment priority for customers was surveyed either their personal loan or car loan. 94% of our borrowers are non-home owners. So they're either renters or boarders. Their number one finance commitment is a car loan with us. It sets us up for the time of success. April this year was our 10-year milestone with the company, and we are grateful for our investors that have provided us the opportunity to grow our business on the national stage. Stephen Jones, who heads up our risk and audit and is a director of Investor Central last month, it was a 10-year milestone for him too. I would ask the Finance One team just to stand for one moment, please. The messages of support that I personally received during COVID were amazing. They were inspirational. But it's these guys, there's only half of them here, half of the team are still back there. It's these guys that rallied to the cause and that were truly committed to make sure that they met our customers' obligations, but our obligations back to you also. It's their dedication and resolve. It's them making one more call a day, doing one more email, or truly being invested in what they do, with that sense of belonging. They inspire me every day. They are my everyday heroes, and I thank you. Thank you, guys. We've started a Brisbane office. These are actual photos from our Brisbane office. As part of our business continuity plan, it is most important that we have a secondary site that if a Category 5 cyclone comes through Townsville and wipes out the Townsville site, that we can still collect the loans, we can still operate in a timely manner and meet our obligations to investors, but also to our customers that have a loan with Finance One. The Brisbane office will also provide us an opportunity to find talent in certain areas that we need. Our investors, they continue to invest in our company as we offer a high yield, reliable monthly return from 3.75 through to 10% per annum. There are no management or establishment fees to maintain an investment in our company. Transparency, it has been the key to our success. We offer a personal approach with a dedicated investor relations team. Our investors, you rank first in preference to be paid above ordinary shareholders. And we have reinvested over 85% of profits back into the company since inception, and we have over $23 million in equity. We offer a fixed interest. It is paid monthly, providing a steady income stream to our investors. Investor Central, it has delivered 10 years of positive returns to our investors, totaling over $84 million since 2010. The company is led by a driven team of executives whom have consistently delivered increased profits and strong returns for all our investors. All of the directors, they're investors also with their own capital invested into the business. And I'm proud to say that over 40% of the Finance One team, they're investors also through a special employment prospectus. Investors are attracted to our fixed terms ranging from 3 months through to 5 years at fixed interest rates from 3.75 through to 10% per annum. An investment in Investor Central is free from any fees and charges to you, which does set us apart from many similar investments. Computershare, it's our share registry. It issues share certificates in the company along with doing the monthly distributions back to our investors' nominated bank accounts. These are the proposed rates for our next prospectus. We're currently finalising our next prospectus, and we hope to lodge that with ASIC either next week or the week after. The proposed rates are very similar to last year's prospectus, from 3.75 for a 3-month term from $25,000 invested, or for a 12-month term up to 4.5%, right through to a 5-year term, it's still at 7%. from amounts from $250,000 to $500,000. A 2-year term is 5.5%, right through to a 5-year term is at 8%. These are the terms that we have changed from $500,000 to $1.5 million. An investor can have more than $1.5 million invested in our company. They just have it in different maturity dates, so we don't have too much capital maturing at one particular point and time. But we've changed our terms at 8% for a 2-year term, or 9% for a 2.5-year term, or 10% for a 3-year term. More of our loan book is maturing and our cash flow is very strong. So we don't want to have too much capital at a 5-year term at the higher interest rates moving forward. Finance One's assessment process. This is what set us up for success. It's about profiling the right client to get a loan with Finance One. Our finance brokers, they supply us with an application form, proof of address and income. Credit file, proposed vehicle purchase, but a minimum of 3 months worth of bank statements on a consumer client and 6 months worth of bank statements on a commercial client. The finance brokers, they are only a referrer of a lead to Finance One. We do all the decisioning within our credit department. We drill down into those 3 months worth of bank statements, making sure that our clients do have the capacity to get a loan with Finance One. We also do profiling around their credit scores and what they want to purchase. Consequently, historically, on average, Finance One only settles 1 in 5 applicants who apply. A unique attribute about Finance One is us managing client relationships throughout the term of their loan. Our team, we work closely with each client to help them through the repayment process and to keep them on top of managing their obligations. Compassion. We see this as an integral part of customers who have specifically come to Finance One to either establish or re-establish their credit rating. There are times when people can experience difficulties for whatever reason, whether that's a loss of income, partner separation, or illness, or a black swan event like COVID. We have the processes in place to work with our customers over this period of time, so it sets them up for success so they can meet their obligations. Finance One's major point of difference. It has been its personal and compassionate approach to lending, allowing us to help hundreds of new clients every month. Historically, we have specialised in secured car loans. Over time, Finance One has expanded its range of products to include commercial loans and also unsecured personal loans. Currently, commercial loans only make up 22% of the entire loan book carrying value. Unsecured personal loans are only a very small cohort, being 0.3% of the entire loan book. Currently, in this economic environment, we're not issuing any unsecured personal loans at this stage. We've taken measures to ensure that we are significantly resourced when it comes to compliance, risk and legal, and we've built out our team with Joan Raffay as our General Counsel heading our team, along with Angus and Katie, who are our lawyers as well. These people are internally employed, and along with Stephen Jones, who looks after risk and audit. There are several changes that have happened in the regulatory changes and landscape. That was the Hayne Royal Commission, and common sense prevailed with the Westpac versus ASIC case for responsible lending. There are going to be some changes to responsible lending moving forward. This is designed to help drive the credit market, make businesses easier to access credit. It really won't change much about what Finance One does. We profile the client and we're a high documentation lender. We want to make sure that we can ascertain somebody's credit worthiness to be able to get a loan with our company. And I invite you to discuss anything that you wish with Joan, who's here today. It gives me great pleasure to run through some of the highlights of our annual report in depth. Our total revenue, it was up 25% from $44 million to over $56 million. Net profit before tax, it was up over 29% from $7.3 million to $9.4 million. That's even after the COVID overlay provision which was $765,000. Net profit after tax, it was up 21% from $5.3 million to $6.5 million. And our total equity, it has grown 31% from over $18 million to $23 million. Cash holding position was over $38 million as at the 30th of June 2020. Loan book value increased 15% from $175 million to over $202 million. And we paid over $23.9 million in interest to our investors last financial year. We have paid over $84 million since inception. This financial year, we will pay over $100 million since 2010 to our investors, which will be a great milestone for the company. And the gap, it continues to grow between the size of the loan book and funds borrowed from investors through the reinvestment of 85% of profits, net profit after tax, back into the loan book. We had nearly 14,000 clients pre-COVID, and the loan book was just shy of $220 million. It's sitting at around that $197 million because we paused our lending and we've also reduced our lending. We lent $6.9 million last month, and as Quinn was explaining to you before, we were lending around $10 million. The success of the business is not just built around loan origination. It's about managing clients, existing clients, through their repayment process. They're the ones that are making their monthly interest payment. We now have 12,500 clients with an active loan. Our average loan size, though, it's only $18,800 for a consumer loan or $28,200 for a commercial loan, so we're not talking big ticket items. We've built Finance One on a national level through a network now of over 1,000 finance brokers promoting our range of products. Risk management, it's a vital part of our business, and we manage this very carefully. As Finance One's loan book matures and operates through this new economic environment, next financial year we're going to be budgeting on medium write-off levels of between 17 and 19% of our revenue for our combined provision for doubtful debts and write-offs. Our total last financial year was 14.6%. Our actual bad debt expense on its own was still only 6.2% of revenue. Moving forward for the next financial year, we're budgeting on medium write-off levels, actual bad debt expense, of between 10 and 12%. Again, these are not titles that we're shooting for, but we're being cautious with this. So even if we have a write-off level of 19% of revenue for our combined total for provision and write-offs, and our actual bad debt expense is 12%, we still meet all our obligations to investors, and we make a net profit before tax of over $7 million. It really shows the strength of the business model. Managing risk has always been a priority for Finance One. We've built our provision to now over $13 million. Our next slide looks at our write-off tolerance levels. This too helps demonstrate the strengths of our business model. If we looked at what we're owed by our customers over the next 6 years, it's more than $302 million in principal and interest. We owed, after cash holdings are returned to our investors as at the 30th of June, $163 million. That's a difference of over $139 million from what we're owed by our customers to what we owe our investors in principle. If we take off our historical provision for doubtful debts of over 4%, we're still left with more than $289 million. If we're to stress test the business model and take a 7% write-off, we'd still be left with more than $280 million. Or if we take that to a full 25%, we're still owed more than $220 million. The write-off tolerance equation helps demonstrate the strengths of the business model. We continue to build a substantial margin of safety. Ladies and gentlemen, thank you for coming today. Referrals are an important part of our expansion. I welcome you to refer anyone whom you feel may be interested in an investment with our company. We offer a high yield, reliable monthly return. Transparency has been the key to our success, and investors, you rank first in preference to be paid above ordinary shareholders. Thank you for all your involvement. To go through an event like that, it means a lot to me, as you probably realise at the start. But my wife is an amazing lady. She's strong. She's resilient. She's been the best thing that ever happened to me. And you go through an event like that, and she's just this rock that is there for you. So thank you, Deanne. Love you. Good job.